Hello, everyone. My name is Bob Grace, Editor and Associate Publisher of Plastics News. I'm speaking to you today from our headquarters in Akron, Ohio, and thank you for joining today's webinar titled Evolving Price Management Opportunities for the Resin Supply Chain. Today's program is sponsored jointly by the CME Group and the Petrochem Wire newsletter. First, a few housekeeping tips before we start. Audio access can be via telephone or through your computer speakers. The telephone number and access code are on your screen. You may minimize the box on the right side of your screen by using the arrow, expand and collapse arrow button at the top of the box. If you have a question for our presenters, please type it into the box on the right side of your screen. We'll answer as many questions as possible at the end of the three presentations. And finally, an archived on-demand version of this event will be available on the Plastics News website at www.plasticsnews.com/webinars about 24 hours after today's live presentation for you or your colleagues to view in its entirety. A PDF version of the presentation will be available for download upon request only. We will show this website address again at the conclusion. And now a few words about our sponsors. The CME Group's exchanges offer a wide range of global benchmark products across all major asset classes, including futures and options based on interest rates, equity indexes, foreign exchange, energy, agricultural commodities, metals, weather, and real estate. CME Group brings buyers and sellers together through its CME Globex electronic trading platform and its trading facilities in New York and Chicago. CME Group also operates CME Clearing, one of the largest central counterparty clearing services in the world. Petrochem Wire is a relatively new face in the information segment of the plastics market. In less than 4 years, it has become a widely referenced source due to its daily summary of the day's pricing activity and operations news in the U.S. polymers, olefins, and chemical feedstock markets. Its ethylene and propylene prices have found prominence as industry benchmarks, and PCW soon expanded its coverage to include the emerging forward markets for olefins and polymer resins. We have three presenters today. Kathy Hall is Executive Editor of Petrochem Wire. Mark Quiner is Senior Editor at Petrochem Wire. And Daniel Brewster is Director of Energy Research at the CME Group. Kathy Hall will lead off. So Kathy, while we hand off the screen to you, the microphone is yours. Thank you.
Thank you. Welcome to the first Petrochem Wire CME webinar. As the spot ethylene and propylene markets have become accepted as credible indicators of upstream pricing, financial hedging opportunities have finally become possible for polymer resin markets. And so, this seemed to be an ideal time to discuss this evolving and exciting segment of the market and to address some of the questions we now receive on a daily basis. I'm Kathy Hall, the Executive Editor of the Petrochem Wire, and thanks for attending today. Given the number of registrants and the diversity of the companies in attendance today, we have structured this presentation to broadly discuss risk management options that are now being implemented within the plastics industry on a growing basis. If you have a question that is not addressed in the Q&A portion today, or a question about how to specifically relate this information to your company, please contact me, Mark, or Dan directly, and we can continue the conversation offline. This slide and the next one may look familiar to anyone who has seen a recent presentation of mine. I use this to demonstrate the idea that what we are currently experiencing in the U.S. olefin and polyolefin markets is actually an old story, but with a new set of characters. Many industries have become commoditized throughout history. None of the contracts listed here occurred spontaneously. Each one was the result of a journey, a series of processes, a shift of how the market thought about the commodity itself. It is the same journey that has been occurring in the U.S. olefin and polyolefin markets in recent years. In 2008, the NYMEX launched a series of futures contracts for natural gas liquids, such as ethane and propane. In 2009, NYMEX launched its first ethylene futures contract, extending opportunities, in particular, for those in the ethane market. In 2010, NYMEX launched polyethylene and polypropylene futures contracts, which extended options to the resin and manufacturing communities to manage their risk along the supply chain. So exactly what has changed in the resin markets? A move toward price transparency is a major change for any commodity market. Remember, the energy markets did not reach this point for nearly 100 years into their existence. Ethylene and propylene now trade every day, and new prices emerge at least every day, and sometimes multiple times during a day. We are looking at a shift in the larger cultural mentality, which in my opinion has two main components: hubs and futures. The development of a commodity to trade around a hub, which I will refer to as having a hub mentality, encourages liquidity. And a liquid market encourages confident forward trading. Viewing the life of a commodity as a journey of a contract that expires in the prompt month is the central driver of trading futures markets. First, we will look at the hub mentality. In the ethylene market, a lot has changed in recent years. For many years, ethylene would trade sporadically in the spot market, and it would always nearly trade for the prompt delivery with a price that was very specific to its point of origin and its point of delivery. As the Mont Belvieu storage area began to be viewed as a hub, the price of ethylene was no longer specific to each deal's delivery point. Because ethylene is a pipeline-delivered market, the delivery point often reveals who purchased the ethylene. But in a hub market, the identities of the buyers and the sellers are not obvious. The spot price of the ethylene largely became known as the Mont Belvieu price, and the confidence of buying and selling on this basis inspired more companies to trade. The momentum continues to build around this hub, as evidenced by the increasing volumes trading on this basis. It has long been debated whether resins are commodities at all, as there are thousands of grades and brands and uses. This has created a mentality that there are actually thousands of prices for resins on any given day, which is true as the price specifically relates to the consumer. In this environment, markets found that they could rally around the idea that contract prices were uniformly settled at similar deltas. Suppliers notify customers of proposed pricing, they negotiate, they agree on a price for a specific month that is relative to the prior month. And therefore the deltas are known, but specific prices are not. Aside from this, the spot market was considered to be the export market, which did not consistently exist as it depends on arbitrage opportunities. But taking a cue from the immediate upstream monomer markets, questions began to be posed about the polymer resin markets. How could the specifics of transactions be peeled away? Transactions in the generic prime market gave a certain degree of comfort. Focusing on a point of origin was another way, but again, describing a price as FOB Baton Rouge or FOB Freeport was really not useful or comfortable. But by shifting the point of origin and delivery to the Houston area warehouses already used for bulk railcar resin storage, the terminology FOB Houston did prove to be useful and comfortable. Auctions began to be held on an FOB Houston basis for generic prime grade resins, and these auction prices demonstrated the relevance to the upstream monomer markets and proved to be influential. Gradually, resins were offered and bid on an FOB Houston bulk railcar basis, mostly through brokers and traders. And over the past year, the FOB Houston market for high-density polyethylene blow molding grade, linear low-density polyethylene film grade, and homopolymer polypropylene injection grade has been consistently bid, offered, and transacted. A hub enables a commodity to trade frequently and with confidence. Famous hubs include the Henry Hub, Cushing, Oklahoma, and now Mont Belvieu, Texas. As it did with ethylene and propylene monomer at Mont Belvieu, a hub mentality is developed around the U.S. resin markets in Houston. Hubs create the opportunity to easily sell into and draw from a central location. And delivery logistics and freight rates are negotiated outside of that FOB Houston price. This includes the option to bag the material and send it into the international markets. The question we hear a lot is, what do hubs have to do with me? Well, if you're a producer, you can sell into the hub and send your product to Houston. If you are a consumer, you can buy from this hub and receive delivery to your plant from Houston. If you are a broker, a dealer, a trader, you can buy and sell at that hub. The price at the hub encourages liquidity, and a relevant basic price becomes known. For those transacting the FOB Houston market, specifics of each deal are worked out relative to the transacted hub price. By creating a strong cash market benchmark, swaps markets can develop. My colleague Mark Quiner will discuss how swaps markets function in just a few minutes. Now we're going to move on to forward trading. And the crystal ball that you see, don't you wish you had one? But we don't. But what we do have are forward markets. A forward curve is a price that you can lock in for a commodity today for delivery in the future. A forward curve is not a price forecast. Instead, it is a snapshot of prices for a moment in time. The future price of a commodity is always changing and is not intended to show where prices are headed. Today, July polypropylene may be valued at 65 cents. Next week, it may be valued at 68 cents or 62 cents. It's relative to today's price. Polymer and monomer markets have historically relied upon price forecasts as their primary method to manage risk. Forecasts are very educated guesses made by very intelligent people. I don't make forecasts, though, but I do follow the forward market trends. This is a chart of actual trades for December 2010 ethylene. As you can see, ethylene for delivery in December of 2010 began trading in January of 2010. So by the time December arrived, positions had already been established in a range below 30 cents to above 40 cents. When viewing it this way, the December market didn't begin on December 1st. December is the expiration month for the December 2010 contract. This is a major shift in how current pricing is regarded. Considering what we've just seen, that a particular month for ethylene, propylene, polyethylene, or polypropylene can trade a year or more before the month occurs, it makes you wonder what positions and prices are being taken today for next year. Again, forecasts do have relevance that's specifically related to a contract's expiration price. If forecasters predict, for example, that crude oil will be $150 this July, and today July crude oil is trading at $100, some people might use that forecast to take a position at $100. This is just as true for natural gas liquids and ethylene and propylene, and it is becoming possible for polyethylene and polypropylene. And at this point, I gladly turn the presentation over to my colleague, Senior Editor Mark Quiner. Mark's extensive knowledge and rapport with the markets covered in our newsletter enables him to view the activities throughout the plastic resin supply chain on a daily basis with accuracy and a dedicated attention to detail. So, take it away, Mark.
Thanks, Kathy. As we move forward, I think it's important to specifically address risk management and hedging. As Kathy alluded to earlier, there's been enormous interest in the past few years among the processor community in finding ways to buy more intelligently. One of the major points of focus has been trying to access better market data so they can make more informed buying decisions. I'd like to think this has been helped along by PetroChem-Wire as we have leveled the playing field in terms of access to market data. However, companies are also looking for more tangible ways to manage this risk through hedging. Companies with exposure to a variety of commodities across all sectors have access to a range of tools to hedge their price risk. However, up until very recently, there have been very few options. Available for companies with exposure to U.S. polymer prices to hedge. Just so we're on the same page, hedging is a strategy that companies can use to lock in prices by offsetting price movements in your raw material prices with other financial instruments. I wanted to use this next part of the presentation to talk to you about some of the basic principles of hedging. Keep in mind that PCW is not a consultancy or a risk advisor. I just wanted to help you understand the basic principles and to plant a seed. If this is something that you really wanted to address going forward, I wanted you to have this basic foundation so you can ask intelligent questions and make informed choices. We can also put you in touch with companies who can help you hedge if you so wish. Financial swaps are the thrust of what I'm going to be talking about. A swap is a financial instrument that represents a commodity. However, no physical product exchanges hands. It is simply an exchange of cash streams. One party receives a fixed price and another party receives a floating price. So how do swaps get their value? Swaps are traded in the open market and always have a price that you can purchase them at. When a swap expires, the swap is settled against an index. The index a swap settles against is an index that represents the physical price of the underlying commodity. A robust and transparent index is critical to facilitating a healthy swaps market, as it ensures that the swap price does not deviate from the physical commodity price. Let's take a look at an example of a swap transaction in the natural gas market. Party A sells Party B a 4Q natural gas swap consisting of 4 contracts per month at $3 per MMBTU. The CME NYMEX natural gas swap futures contract settles each month at the expiration of the physically delivered NYMEX natural gas contract. The average of the settlements for October, November, and December of 2011 determine which party owes the other money. In this example, the October contract settles at $3.18. The November contract settles at $2.80, and the December contract settles at $2.82. The average of those prices is $2.93. In this example, the seller pays the buyer 6.6 cents, or $2 million. For a swaps market to function, there has to be 3 key components: a robust physical spot market, a high level of transparency, and an accurate, credible, and independent spot index. Swaps exist in a variety of markets, from debt markets to agriculture to energies. There are now olefins and polymer swaps listed through the NYMEX that give processors access to trading and risk management opportunities that were not previously available. So why would a processor buy swaps? Swaps can be used to offset fluctuations in physical resin prices, called hedging. Now that we understand how these swaps work, let's go through the basics of how money changes hands in a hedge for a processor. Before we go any further, we need to understand the concept of basis risk. Basis risk is the risk associated with imperfect hedging using futures. It could arise because of the difference between the asset whose price is to be hedged and the asset underlying the derivative. When a plastics processor hedges with a swap, your transaction has 2 legs: the physical railcar purchase and the swap. This illustration shows the flow of money for each leg of the deal. To have 0 basis risk, you, the processor, purchase the railcars from your supplier at index and receive your physical railcars. NYMEX olefins and plastics contracts settle against the petrochem wire, so in this instance, you ideally would purchase your cars on this index. You then turn around and purchase your swap at a fixed price from the NYMEX, and in return receive the PCW index. Settling your physical cars and the swap against the same index allow you to effectively lock in your physical rail cars at the price you paid for your swap. This is because as the index moves up, the increase in your physical resin price is perfectly offset by an increase in the swap's value. The opposite is true when the index falls. Plastics hedging isn't just about picking a new index. These contracts represent opportunities to change the entire dimension of pricing resins in the U.S. Let's take a look at some of the key risks associated with using hedging instruments. The first is liquidity. The CME paper markets for olefins and polymers are growing. The gap between buyers and sellers, or the bid-ask, is still wide, and they are not as easy to get in and out of as crude oil or natural gas. But the markets are growing. Regardless, if you're a processor or a producer looking to hedge, you simply need to hold your swap to expiration and do not need to trade out of it, if that's your sole purpose. The second risk factor is performance. What if your counterparty flakes? We've heard of this happening in markets. When somebody flakes on a deal, it leads to more than hurt feelings. Lawsuits are expensive, and it discourages people from participating in the future. The NYMEX contracts are cleared. It's impossible to flake on a deal cleared through the CME. They have significant capital and systems in place to ensure that parties perform all the time, which Dan can talk in more detail about shortly. The third risk factor is index. Having a reliable benchmark is critical. Producers, consumers, and traders all need to have faith that the settlements for the swaps are transactable. Participants at all levels of the markets need to be confident that if they transact physical railcars, that their transaction will be reflected in the index. Indexes that only track movement and not actual transactions are risky, as they can deviate over time from the market. The Petrochem Wires Index fits this bill. It's low risk. It is designed to track actual spot market transactions around a hub, the Houston area, and to inspire confidence for participants to participate in the swaps market. Increased liquidity in olefins and polymers has created daily opportunities for resins risk management. Every day, the price of key NGLs, monomers, and resins are discovered, communicated, and published. The development of resin swaps completes the supply chain, allowing for significant risk management opportunities from the wellhead to the pellet. The best part is counterparty performance is guaranteed and creates significant credit efficiency. At this point, I'm going to turn the presentation over to Dan Brewster, who will talk more about the CME's role in this.
Thank you, Mark. This is Dan Brewster at the CME Group, and today I wanted to talk about the clearing services that we provide for the various NGLs, monomers, and polymers, which we now clear on our CME ClearPort system. What I'd like to do now is to start. Excuse me, let me just key to my next slide. What I'd like to do is just run through and give you an overview of the product offering that we have at CME, which includes a full clearing services for the NGL complex, as well as that includes 2 monomers, and we offer clearing services for some of the polymers as well. Looking at our NGL complex that we currently clear, we have 41 various NGL contracts, both cash settled and physically delivered. And we have, very liquid cash-settled NGL swaps at both Mont Belvieu and Conway. In addition, we offer a European ARA propane swap as well as a Far East propane swap. In addition, we clear some physically delivered in-well NGL contracts at Mont Belvieu and Conway. And currently, if you look at our ethane and propane contracts, we currently have about 50 million barrels of propane that are hedged forward through December of 2013. And on ethane, we have currently about 20 million barrels that are hedged forward and cleared through December of 2013. If we focus on our monomer product slate for a moment, we offer futures contracts on both ethylene and propylene. Our main ethylene contract is physically delivered in well at Mont Belvieu, and that has substantial open interest now through September of 2011, and this allows clearing through or trading through the second to last business day of the current month, which is, an in-well type of transaction, which is, similar to how ethane trades. In addition, we have a financially settled ethylene swap, which is based on the monthly average of the PCW price, and this has open interest now through December of 2011. And we also offer the PGP swap, which was recently launched, and that's another exciting new product. In addition, a few months ago we added the cash-settled polymer swaps based on the PCW index price. The high-density polyethylene swap, which and these are based on an FOB Houston price, and these contracts are based on a 47,000 pound size. We also offer the linear low density polyethylene as well as the polypropylene swap. And we've seen the activity really start to pick up in these, and we're very pleased to see that. In addition, we have two physically delivered polymer contracts, the high-density polyethylene swap, which is an FOB Houston delivered price, and that has a significant amount of activity, and we have now about 20 million pounds of HDPE that's priced and hedged out on the forward curve. And we, looking ahead, we're still interested to expand our product slate, and we've been, we're looking to expand to the global market, both in Europe and Asia, and we're also looking to add some additional monomers and polymers, such as the PET resin and polystyrene. So overall, we're very pleased with the activity that we've seen with our clearing services, and that pretty much wraps up my comments. So let me turn it back over to Kathy.
Hey, thanks, Dan. I will now begin the Q&A, and thanks everybody who's been typing in questions. Some of the first things I wanted to touch on, some people have said, what does this mean? What does that mean? What did I mean by arbitrage when I talked about the international spot market? And by that, I simply mean a price differential that would be regional. So for example, if resin in the U.S. is $1,200 per metric ton, and it's $1,600 or $1,700 per metric ton in another region like Europe or Asia, the arbitrage gives the opportunity for the U.S. to sell to other international markets. The arbitrage does not exist from those markets into the lower priced ones. So that's, I hope that was helpful. Excuse me. The other is, and this is for Dan. Usually Dan gets most of the questions. So Dan, can you define what open interest is? What does that mean when you say there's a certain amount of open interest on a contract?
When we say open interest, that means contracts that are being cleared where there's both a buyer and seller, where they've locked in a futures contract between them to hedge out into the future. So open interest represents one contract, futures contract, that's being held by both a buyer and a seller. And those are standardized contracts, and the contract size for the polymers is typically 47,000 pounds for a contract size, and then for ethylene and propylene it's 100,000 pounds contract size. And then for the NGLs, it's typically 1,000 barrels is a typical contract size for most of the NGL contracts.
Mm-hmm. Okay, thank you. Another thing, Dan, can you explain what in-well physically delivered means?
An in-well transaction is typically how the NGLs and the ethylene and propylene are traded, where the product is held or stored in tank, either in Mont Belvieu or, in the case of NGLs, also in Conway. And companies typically have storage there, and they buy and sell and move the product amongst each other, you know, in the cavern themselves, and they buy and sell and hold that product for delivery between themselves. So it's just the typical way that the industry transacts their purchases for the NGLs and the monomers.
Great. Thank you for explaining that. Also, we've had some questions on, and Dan, this is all you. What are the requirements to set up a Clearport account?
Well, the first step would be to contact one of the clearing members that can you can open an account with, which typically it's similar to just opening a futures account, where you would need to go to a brokerage firm and you would fill out the paperwork, and generally there's margin requirements. So depending upon the amount of product that you would like to hedge and the number of futures contracts that would be equivalent to, you would have to put some cash margin into your account, and then at that point we can just permission you to start clearing on the exchange.
Great. Well, thank you. Also, we've got some questions. We've got a lot of questions coming in about specific things. Can you launch this contract, that contract, this specification, this type of thing? I mean, that's something that I think anybody who's got those ideas and questions about other types of contracts, Dan's team is always looking for that exact feedback, and that's largely what has propelled the contracts that you do see. It all starts with you all. So if you have an idea or a question, Dan's team makes it happen, and that's so, you know, and kind of related to that, we've had a couple questions about the London Metal Exchange, and I think my colleague Mark has given some presentations about that, about the what's the difference between the LME polymer futures and the NYMEX polymer futures, because as we know, the LME is opting to discontinue those contracts, but yet here the NYMEX is pretty much recently launching them in the same type of vein. So Mark, can you talk about that?
Sure. And you know, I saw another question as well that's kind of similar, which is you know, why will this contract or these contracts succeed if the LME doesn't succeed? And I guess the difference is that there are several differences, but one is that the LME contract was for bagged material, and you know, I think there was a concern with the LME that because it was bagged material, people didn't want to take delivery of that domestically. They wanted rail cars, bulk rail cars, and so as a result, we would see prices get disconnected from the U.S. domestic market, and it didn't correlate well to people's domestic price. I think the idea with the NYMEX contracts is that these are bulk rail cars, And so they can go into the export market, but they can also be taken from Houston into the domestic market. So if prices start to get out of line domestically, then they can just buy them and take them into their facility. And so I think that's one of the reasons that they'll succeed, and they're going to, they should just correlate better to people's domestic resin purchases.
Thanks. There's also been a couple questions that address the idea of the low price versus the known price. Saying, what if I get into a hedging position that seems to be going badly for me? What do I do? And other questions have been, asking if we can discuss the difference between having the price known going forward versus kind of waiting and hoping that the price is low. So, Mark, maybe you can also talk about that, because I know that's something that you talk about with a lot of people every day when you're talking to especially a processor about what's going on in, say, the 2012 market.
Sure. You mean what is the difference between the prices that were, if you choose to lock in a forward price versus a forecast? Is that what you're?
No, the idea of the downside of the hedge. That it is risk. But that the also how you can hedge the chain.
Right. Yeah. I mean, I think one of the biggest concerns I hear when I talk to processors who are looking at hedging is if we were to, we know that we can lock in our resin price today, at this certain level, but what if there is, what if the market suddenly falls? And so I guess the thought I had, most people it seems that are looking to hedge are going to, lock in a price and have some sort of sales contract on the other end. So it's really, you want to make an informed decision on when you're going to lock in the price and try to time it so that the price works for you. But on the other hand, you want to go in and know that you have a certain amount of margin locked in between your resin costs and your sales price on the other end.
Well, for example, in the physical cash markets, we see lots of people in those, and for a resin producer, for example, they're looking at things a little differently than a resin processor. Can you explain why resin producers would also be interested to hedge, and that they're hedging upstream as well?
Yeah, absolutely. I mean, a resin producer is in a perfect situation to lock in a certain, a certain portion of their production. Resin producers, would have, have the ability to take advantage of extremely liquid ethane markets and propane and butane and C5 or whatever type of feedstock that they're using in their cracker. And so it's very easy for a producer to go out and to lock in their cost for producing resin. They can also go out and take advantage of a fairly liquid ethylene monomer market, so you could lock in your ethylene production as well. And the last piece of it is that the producer has always had a lot of risk on the end at the end of their production chain with fluctuations in the resin price. So this is a good opportunity for a producer to go out and to lock in a sales price for maybe a portion of their production, so that they can guarantee some margin, whether it's a margin back to ethane or a margin all the way back to crude oil if it's an integrated oil company.
Thanks. Also, we've had a couple of questions about when you're talking about a swap. Dan, maybe you can walk us through this. With swaps in particular, how exactly are they settled? Because I don't know if I think some people are wondering, there is no delivery, but what exactly is being settled, and how does that go? When does it settle? How does it settle? And maybe if you can use resins as an example, that seems to be a question.
Okay. Generally, the swaps are monthly average pricing. So each day of the month, as we get the PCW closing price at the end of the day, we'll put that in, and at the end of the month, we'll have the monthly average price, which we will then calculate. And then 2 business days after the end of the month, we will basically close out that swap and flow the cash, either a gain or a loss, and cash settle that swap after the end of the month. So basically, companies can kind of lock in that monthly average price, and if they have some risk on the other side of that, then they will get the cash flowing based on that final settlement price.
Thanks. Also, Dan, maybe you could talk about how the resin contracts have been performing so far. I know Mark had touched on that. There is some, of course, when any contract first begins, there's liquidity challenges, and I think that's something that is a concern for people. But I don't know exactly how the contracts are performing, both the physical ones and the swaps.
Okay, well, actually, the physical high-density polyethylene, which is an FOB delivered price in Houston at a couple of the warehouses in Houston, we've had significant activity in that contract, and we currently have about 20 million pounds of open interest going out the curve, roughly about 9 months forward on that. And then the cash settled swaps, which we launched a couple months ago, we already have about 7 million pounds of exposure that's been hedged out already in the polypropylene swap, and the HDPE, the high density polyethylene, has currently about 4 million pounds of exposure that's been hedged out on the forward curve. So, and every day we're getting pretty active, bids and offers, and people are really starting to get some activity going. So we're looking forward to some good growth, and I think it helps with liquidity when you don't have to worry about counterparty risk.
Sure. Well, another question that we've got here is about speculation, and especially how that relates to liquidity. And Dan, maybe you can also address this, because you have experience in so many markets, that when a contract is first developing and liquidity is still also developing, do you see the opportunity for a lot of speculation?
I mean, generally, when markets are fairly new, there isn't a lot of speculation, because most of the activity is now, in the NGLs and the monomers and polymers. It's mostly commercials who are hedging their price risk. And over time, as liquidity grows, you'll start to see some speculative opportunities. But right now, in the NGLs and monomers and polymers, it's probably 99% commercially related transactions. So companies are just trying to hedge their price risk, and we haven't seen much in the way of speculative activity. Usually, speculators tend to want to have a lot of liquidity, and in these markets, as they evolve, as liquidity begins to grow, there may be, some speculation may start to occur, but at the moment, it's mainly just a commercially dominated market.
Thanks. We've also had some questions about the petrochem wires price discovery process and mechanisms. And excuse me, I'm going to give that to Mark. And Mark, maybe you can talk about essentially what we all do every day at the Petrochem Wire in putting the newsletter out and making these price discoveries.
Sure. Yeah, basically, when we are putting out prices, our prices represent firm bids, firm offers, and confirmed transactions, and that's the case for both ethylene, propylene, as well as polyethylene and polypropylene. These markets are OTC markets that transact through brokers and on electronic screens and that sort of thing. And we survey brokers and traders and buyers and sellers and confirm where they're at in the market, and that's what forms our prices. So if there are days where there's not a lot of liquidity, then we will make a more academic assessment based on where the market was the previous day. But as soon as somebody transacts and reports their deal, then that ultimately is what is reflected in our price curves.
Thanks. We've also had some questions about how possible it is to hedge resin against crude, and that's something I'll talk about that for a minute. But Mark and Dan, if you have anything to add to what I'm going to say, please do, because of course, Dan, I'm sure you're talking with a lot of people that trade many markets at once, and but I think that a lot of it's about correlations. And I know a lot of times I'll meet people that are in manufacturing, and they'll say that they watch the crude and natural gas prices every day as an indicator of where the markets are going in some sense. I think a lot of what we've talked about today is that crude and natural gas are certainly important, but that the correlations are not especially perfect. And that's, I think, always been a challenge when the idea of how to hedge resin exposure has been addressed, that there is no easy crude polyethylene hedge, but that by extending those opportunities down through certainly NGLs and ethane, of course, you can extend that into ethylene, and ethylene into polyethylene. Well, now you've got some real opportunities that do have correlations that you can hedge polyethylene or hedge your risk through ethane or through ethylene, where in the past I think that crude has not really been ideal for that. That these are a better way to find those correlations. Does anybody have any, I don't know, Mark?
Yeah, no, I agree with you on that. I mean, the closer you get to the product that you're actually trying to hedge against, the better chance you have of having the less basis risk you have. So I guess for it really gets down to how you structure your contracts. And if you're a converter that's looking to hedge out your exposure, you can look at the correlations between crude, natural gas in your resin, and you can also look at them between ethane in your resin, ethylene in your resin that you're hedging against, or the polyethylene, the PCW polyethylene prices or polypropylene prices in your resin, and see where the correlations are best. Obviously, if the correlation isn't perfect, then you have risk of deviations between your hedging instrument and your actual and your physical resin price. So the zero risk way to do that is to simply have a supply contract that settles against the same index as the swap that you're using to hedge out your exposure. So so that's that's kind of the way that I would look at it.
Okay, thanks. And now next question is for Dan, and this kind of goes to maybe feedback that you've received specifically around any of these hub contracts. Some of the questions we've gotten have been about resins, but I think that it's applicable to anywhere that you've got this hub mentality. Now, if you're not transacting around the hub, do people find that the hub creates an inefficiency because you're paying to get things to the hub, to get things out of the hub, as opposed to direct trade, which would be just a single, say, freight cost or something like that, or a transmission cost? But as you've seen various markets develop, particularly NGLs and ethylene, I don't know what sort of feedback you've heard about the efficiencies that have been created about trading a hub like Mont Belvieu or Houston or or Cushing or something.
Yeah, I think with commodities, usually if there is one kind of central hub where you have the most participants that are transacting all at one location, you get kind of the benefits of liquidity plus the the pricing benchmark, which what usually happens is when people, the further away they get from the hub, they still kind of price at a differential, maybe a transportation differential to that hub. So it's still kind of an efficient way to price where maybe there's only a location differential which is fairly fixed, so that you can look at a screen and get a pretty good liquid price at that hub, and you know your kind of fixed transportation cost, and you can price accordingly. So that's generally how the markets do evolve, and in the end, I think it brings a lot of efficiency to the market because everyone can be on the same page looking at that hub price, and then they can kind of derive and negotiate from there for their premium or discount. So, and I think what's happening now certainly with the NGLs and the monomers, and we're seeing it in the polymers as well, is that that hub price really is the liquid price that everyone can see, throughout the day. So it works out well.
Also, I know feedback that I've gotten, and I think you've related similar feedback, is the credit efficiency, and maybe you can talk about that as well.
Yeah, exactly. I mean, companies no longer have to extend credit lines to counterparties, and one of the things that really can hold up a transaction is worrying about how much credit risk that you want to extend to a company, especially if it's not clear that their financial condition, and it makes it much easier. You don't need your credit department to do extensive research into a company because with clearing, basically the credit risk is taken out of it, and you actually can increase the number of counterparties that you can do business with and still maintain that credit integrity. So it really makes it much more efficient, and expands the number of companies that you can potentially do business with.
Thanks for that. Mark, maybe you can take this. We've had some questions about really explaining what's the difference between a swap and a physical NYMEX contract and a traditional supply contract.
Sure.
I mean, just an overview. Like, for example, I know with a physical supply contract, you probably have one price for the entire month.
Sure.
So,
yeah, absolutely. The NYMEX futures contract, you're paying a fixed price, and in exchange, you're contracting to receive physical delivery of the product. So you pay let's say 58 cents for high-density polyethylene for delivery in March, and you receive those rail cars in March, and it's cleared through the NYMEX. A supply in a swap, if you were to buy a March high-density polyethylene swap, you would pay a fixed price, let's say 58 cents, and in exchange, instead of receiving the physical product, you receive a floating price, which is the index. So you pay 58 cents, and then when that swap expires, on the last day of the month, then you receive, the swap will be valued at the PCW index. The NYMEX futures contract is a it's a spot price, and so that price changes with each transaction that takes place. So prices can change daily, they can change multiple times a day, or they can change multiple times a week depending on the activity. A traditional supply contract, it's something that people have a lot of different ways of pricing out their resin with their suppliers, and it's it may be a certain volume over a certain period of time, and they may have other factors other than simply a fixed negotiated price that goes into pricing whatever the product is.
Great. And then, Dan, maybe you can also just, with respect to resins in particular, can you talk about what constitutes a trade? What constitutes a contract? What does it mean when you engage for a trade? And also how that relates to the metrics that you use, open interest, daily volume, that sort of thing.
Okay, the standard size in our futures contracts for the polymers is 47,000 pounds, which 4 contracts basically equates to a rail car. So it's for the physically delivered polymers, companies that have delivery capability in Houston can obviously buy and sell and lock in prices and actually take physical delivery, FOB Houston. For other companies that aren't located in the Houston area, they can still lock in that price with a cash settled swap, where they can get the equivalent size and approximate a rail car, and then lock in a price, either if they want to sell at this current price level, or if they want to buy at these levels out in the future months, they can buy or sell that swap, and that will then lock in that price. And once they go to physical delivery in their local region, they can then allow that price, that swap, to cash out, and they can take that profit or loss that they have on that swap and assign that to their physical delivery in their local area. So the cash settled swap allows companies a lot of flexibility as far as being able to lock in a price, but not necessarily having to take the delivery in the Houston area.
Thanks. We have one question that maybe is a little bit in conjunction to that if you can clarify for everybody. When you're taking a forward position, when do you pay? Do you pay the day of the trade? Can you walk people through how that goes? If somebody's trading the 2012 market, what does that mean for them financially?
Well, once you lock in, and let's say you want to sell a swap say in December, you can put on that position, which would be at today's price, selling it, locking in that price, and then you will each day be marked to market. The price will fluctuate between now and December, and let's say prices collapse in the next few months, we would be then settling that swap every day at kind of the current market price, and you would be getting a certain amount of cash flow, either profit or loss, throughout the life of that swap, and then we would hold margin to to guarantee the performance of that swap. And then at the end, at the end of December, once we have the final index price for that swap, we would then price it out, close out the swap, and the cash then would flow between the buyer and the seller at that point. So basically, you would be able to lock in a price. The cash flow would come, through the life of the swap, and then at the end it would go transaction that you might have based on that.
Thanks so much. And then, Dan, one small thing I just want to ask if you could specify, and then we're going to have to start wrapping this up. Can you talk about margin requirements and what that means?
Yeah, we have a certain amount of cash that's kind of the minimum amount of cash collateral that's required for each swap, and generally it really will depend on the price volatility in the market, but currently, the margin requirements on our polymer and NGL and monomer products are really quite quite reasonable, and then that margin is held just as a guarantee of performance. And then if the market becomes very volatile, and if from time to time if we need to increase the margin based on the price volatility, then we can also from time to time collect some additional collateral for that. But currently most of our margin requirements are really quite reasonable, and it's a small price to pay for that credit protection. So
great. Well, thank you very much. I think I've had a great hour, and I hope everybody here has enjoyed it. And this presentation will be available through our host, Plastics News. And if you have any questions to follow up with, you can email me at Kathy@petrochem-wire.com, and I'll put you to the right person if it's not me.
Well, thank you, Kathy, and thanks to all of you for attending. I think the level of questions indicates a great degree of interest. So I appreciate everyone attending today's live broadcast. You may watch the archived edition of this webinar and request permission to download a PDF of the presentations at www.plasticsnews.com/webinars for sometime from about this time tomorrow on. And so you can tell your friends and colleagues if you think they should also watch it. So thanks very much. And again, we appreciate the support from the presenters and the sponsors, and have a very good afternoon. Take care. Bye-bye.